Hi, I'm Anthony Parent of IRSMedic, Parent and Parent LLP, and today I have Robert Hansen, our lead international attorney, joining us to go over some of the Subpart F changes that occurred in our lovely tax reform.
Right.
And I remember this was in June when I think they rolled out the postcard. The tax reform on the postcard, and
Right.
that was one of the, I was laughing at the point. I said, there's just no way. I can believe in lower rates,
Right.
but what I can't believe is a simpler tax code, because that's just sort of impossible. And as we saw it play out, it didn't get more simple. And let's just go, what is Subpart F? Let's just give a little refresher for those of us who might not.
Sure. So Subpart F is the part of the tax code that creates a kind of deemed income for people who majority own or have majority U.S. person owned foreign companies, foreign corporations in specific. And so you might not be receiving a dividend from your foreign company, but depending on what type of activity that the company's in, you might be said to have received income. So you might get a bit of income and extra tax that you're not really expecting.
Okay, so what Subpart F is doing, it's saying that, hey, I didn't get any money from this business, but the business made money, and they're like, well, you should have taken it, I guess.
Right. I think it's envisioned to be some type of anti-abuse rule, because the kind of activities that we're creating Subpart F for are the kind of activities where people might do some shenanigans, possibly.
Right.
So we're going to hit everyone with the Subpart F income. So even if your company isn't doing shenanigans, or let's just say, you didn't realize that your worldwide income was taxable because it's maybe something that you left in, let's just say, India or the UK or whatever it is, and it's UK source income. I pay taxes on it in UK. And isn't there a treaty that takes care of something like that?
Double taxation treaty.
The double
right.
tax treaty.
Yeah. And so the treaties usually don't help out, really.
Not really. Not with that savings clause. For individuals, not much help at all. For companies who can really take advantage of the multi-jurisdictional parts of the treaties, they can get much more benefit, but individuals it's much harder.
Yeah, and just to give you a recap of how it works is when you're an individual, you are a U.S. person, and you can go become a Danish citizen too, or whatever it is. But ultimately, you're a U.S. person, so you can't shift your jurisdiction out of the U.S. But when you're a multinational, you could say, well, I'm not a U.S. company. I'm in Luxembourg now.
Right.
And now you get a Luxembourg, Switzerland tax treaty that applies. So the U.S. treaties don't apply. And that's where you see all these wonderful shenanigans going on that the tax reform tried to, I think we saw them try to end some of these abuses, and I say that in quotes because they're just sort of, trying to increase shareholder profits as best they can, as legally as they can. So that's the difference why a lot of this tax planning that you see while you as an individual can't do the double Dutch. Is that the double Dutch reversal?
Double Dutch with an Irish sandwich, or is it double Irish with a Dutch sandwich?
Something like that. Something like that. So if you're an individual, don't look for that to happen, and don't look for these. And I think people are always looking to say, well, I know that, let's see here. I just read I think Amazon made, I don't know, $6 billion and didn't pay taxes. I don't know if it's true or not. I read it this morning. And as an individual, you're like, okay, well, let's see. Amazon's doing some offshore shenanigans. Maybe I could do those too. And that's where I think there's so many promoters out there telling you, like, oh, go with an offshore trust. This is what Amazon's doing. No, that's not what they're doing at all. So that's where you got to watch it. Don't look for that. And our general advice is when you're looking for some tax savings, you should look, if you're just looking to go internationally for tax savings, don't.
Yeah, no. I think that's right.
No, you want to be overseas for a reason, that there's a huge opportunity, or you're living there. Those are really the reasons why you don't want to just throw your investments overseas and expect to see some sort of savings. And actually, you could see bad things, because Subpart F is actually worse. Yeah.
I mean, you figure it this way: if you have a domestic company, you're in. Let's just say you're in Connecticut, and you have a company in Texas. I don't think you have a federal Subpart F.
No, you don't.
Extra.
But why is it so bad? Why is Subpart F so bad?
Well, like I said before, because it's deemed.
Yep.
So
you actually didn't get the cash.
You didn't get the cash.
So how do you pay your taxes? I didn't get the cash. Right. There's one problem.
Right. Your house rich and dollar poor.
Yeah.
Someone with a brand new house who just got a down payment. Look at this. You've got $1 million asset here. You owe taxes on this. You're like, I do not have the money.
I don't have the money.
You're ripping wallpaper off the, and sending it in as an in-kind payment. So it's way more compliance cost.
Yeah.
Because I've done that, and even for me, it's you got to do it a couple of times to really figure it out. It's deemed income, so you don't have the cash necessarily on hand.
Yeah.
And let's say you're making money, but this is maybe something separate from whatever it is that you're handling. Now, it's pretty complicated. There's earnings and profits you can take out of it. The whole point is it's a large compliance cost sometimes for income that you're not actually receiving.
Yeah.
One of the things I tell clients is like, look, you're probably going to have some deemed income on this. Actually get the money, because you might as well get the money and use it and enjoy it and then pay taxes.
There you go. Right. Yeah. Yeah. No. Well, now what's the tax rate on Subpart F?
I believe this flows to your tax return on as ordinary income.
That's right. So you actually get, so you could actually have, if you had the same investments in the U.S., you could pay the dividend rate of 15 and 20% or 23.8 could be your top theoretical rate on that. But where you have now as ordinary income, the top tax rate with tax reform is 37%. So now you just by having the same thing overseas and it being treated as Subpart F because it's this overseas income that is subject to abuse, you've just ended up, not only did your compliance costs go up, but you also now have more tax bill to pay. And you also might have a problem getting the money because a lot of times you have these controlled foreign corporations, but you actually might not kind of control it all the way. There might be something kind of holding you back.
You'll have other shareholders.
Right.
It's you're a controlled foreign corporation when you're 50% or when you're over 50% owned by U.S. persons. So you could have 4 or 5 or 6 of them, and a lot of them don't want to do the same things that the other ones do. So you might be you might be stuck.
Yeah. That's absolutely right. So now how did the tax reform change this? And so that's kind of right. I mean, so far we've talked about, okay, these are the general rules, but what did the tax reform do to this?
Well, some subtle but important things, but I think left a lot of it intact, to be honest. Got rid of the, there were certain types of income that fit into Subpart F. One of them was insurance income, one was sales income. The one that seems to be removed now is oil-related income.
Okay.
So if you've got oil-related sales, that's no longer part of Subpart F.
Okay.
So that part's just more or less taken out. But everything else is
that's good.
It's still in. That's good for people who have oil businesses.
Okay.
I don't know how many people there are out there that have
international. I mean, the domestic market is going great.
Yeah.
I mean, Texas is jamming away there. But so it's not going to help too many people out.
Not too many people. Well, but then the other important subtle thing they did was they changed how long during a calendar year that you have to be a controlled foreign corporation.
That's right.
To trigger the Subpart F. It used to be a full month, which is still not very long.
Right.
Now it's at any point. It could be a single day that you had. Let's say, oh yeah, it was like me and my dad. We together we were over 50%
for a day, right?
But in the next day we switched it and took me off. Too bad. You've got Subpart. You are a CFC for the entire year.
A controlled foreign corporation.
Yep.
So now we have some reporting requirements triggered. We have a 5471. 5471 that's going to be required. Yep. Which is we've done a whole series on that. Sort of the complications behind that. It's really something else. It's sort of it exceeds your imagination on how complicated it could be to report something that could be quite simple.
Yep.
That if it was something domestic, it could simply be something you would put on a Schedule C, and it would take a tax preparer around the corner. It could take them 30 minutes to do it. But you could have the same exact thing overseas, and now you're talking about 8 hours of one of our experienced people to help out to get it done right, because the consequences here are completely different.
Oh my goodness, yes.
Oh my God, if you're wrong on your Schedule C, okay, here, we're going to fix the number, you owe this. And it's just a percentage of, or it's whatever your tax is.
You took a few too many meals on your expenses. Right. We're going to take those out.
Right. But now the difference is on your 5471 is that if you just have something, let's just say it's your balance sheet that isn't right. And your balance sheet has really not a lot to do with your income. You just put down, what's wrong with your balance sheet? Well, you didn't use the GAAP standards. You used the international standards. Therefore, you really didn't, this isn't substantially complete. So, we're going to penalize you $10,000 for each of the years that you've done.
Right.
And when it's substantially incomplete, we're going to count it as not being filed at all. So actually, your entire return is still open. So it's $10,000, and fix it too. And if you don't fix it,
Now.
we're going to penalize you $60,000 for each year again. So you see the complete difference. You know, a domestic problem is, it could be an automatic bill pooped out to say, hey, this is what you owe, pay it. Okay, great. You just pay it and you're done. Whereas internationally, like now, this is just an onion of misery, sort of unpeeling itself. If it's not done correctly.
With
Now,
every layer you go down, you cry a little bit more.
oh, there you go. Yeah, that's sort of true. And yet you never get to the middle.
No.
It just sort of keeps on going, keeps on growing, and you're trying to catch up with it. Now, tax reform, it did with Subpart F, and I know this, there's retained earnings that people have with their Subpart F over the years. That if it was, well, I guess Subpart F, you would have no, if everything that you were taxed on since you've been overseas was all Subpart F income, you don't have a problem as with the new excise tax. Well, not excise tax passed on retained earnings, because your retained earnings, Subpart F sort of taxed you on your retained earnings, so you don't have that anymore, correct?
Well, I'm sure the new excise tax for this year is essentially just a Subpart F addition. On the form, there's going to be a new line they're going to insert, and you've got to go do this extra calculation to do 15.5% on your retained cash and 8%, I think it's 8%, on your other non-cash retained earnings. I'm not sure. And there are ways, basically, it's cash retained earnings and then everything else at 8%, whatever everything else ends up actually being. Accounts receivables, things like that, things in lieu of cash. That's just in addition to for this 1 year. And you're going to get hit with it regardless, because there's the December 31st value. And then they said, well, if not December
31st, 17.
Of 17.
Right, so that day already went.
Which already, and by the way, the thing was passed on like the 22nd.
Yeah, right. The 20, I think it was the 22nd. So we're like, okay, what?
Right. Now, you might say, even if you had, let's say, an army of attorneys who as soon as that PDF was available online, they printed that sucker out and they had rifling through it and reading through, hey, look, it looks like retained earnings on December 31st. Quick, make a bunch of distributions, reduce it. Not so fast. Congress is, you might not like them, but they're not dumb. It's the highest of December 31st or November 2nd is when you get your excise tax. So you're probably going to get hit with this regardless.
Wait, November 2nd, 2017?
2017.
Oh. Well, yeah, you're sort of, there's nothing you could do.
There's nothing you can do.
There's nothing you could do. Yeah.
On November 1st or October 31st, you're not going to be like, I think Congress is going to be doing an excise tax in the near future. I'm just going to sit there and think about this. So you're probably going to hit with this regardless. Now, there are some things that will reduce whatever this excise tax is.
Yep.
Earnings and profits, foreign previous payments, things like that. But you're going to have to go through basically your books, your current year books, and then your past books to see what you did.
Yeah.
And then do the calculation. I'm not even sure if the IRS knows how to do this perfectly. My guess is probably not. It's going to be... Like for the attorneys and the CPAs who are looking at this stuff, it's going to be the same thing. They're going to be learning it and doing it on the fly a little bit.
Yep.
Because guess what? Your taxes are due in April. We passed this thing in December. Figure it out. And by the way, we're still working on the 1986 tax reform. So still trying to figure that one out.
Yeah, there's still areas there where they're not entirely sure on that. So right now, what we're working on is with our clients with international business overseas, is we're trying to figure out ways to reduce the subpart of income and also this excise tax. And there's a few strategies that we like to employ, and some of those are on our channel, and we'll be discussing those more in the future about how to reduce some of your liability. And I know there's a group going around right now because there is that excise tax. There is a petition right now because that's going to hit some of the expats who are living overseas, middle-class people who might be hit with this really big. There's a petition going on right now. Our friend John Richardson is helping out Republicans overseas to get this petition of the unintended consequences of tax reform, that this excise tax is hitting people. There's a petition to get the IRS to sort of create a regulation and say, hey, look, if you're living overseas, we didn't mean to hit you with this. And that was really the whole idea of this excise tax is to say that the idea, I think if we looked at what Congress intended to do in the grand scheme of things, to say, okay, we want to stop taxing worldwide corporate income, but we don't want to leave all this money on the table. So look, if you've been deferring taxes forever, pay this tax in lieu of your repatriation tax, or actually that's probably the closest thing to call it, a repatriation tax. And so that was the idea behind it, which seems to make a lot of sense. Now the execution of it happened a little funky there, and now it sort of has all these unintended consequences. And this is where you're trying to do something as weighty as a tax reform of the most complicated thing in the world, and I would say that's the 1986 Act, is the most complicated thing in the world, and now you're trying to do a very one-sided, a non-bipartisan thing to get this to pass because it's got to score under a certain thing.
Yep.
So that's where a lot of ugliness happens, and so there's a lot of surprises, but there's also some opportunities that we're seeing, and we'll get to some of those later.
Sure.
So subscribe to our channel as we talk about those. We're going to be talking about those distressed economic zones, right? That's something really, really interesting where you could probably defer some of those ordinary gains that we're talking about maybe forever, and doing it all legally and making some great investments along the way.
Yep.
So, Robert, thank you for joining me.
You're welcome.
Again, this is Anthony Parent for IRSMedic. Thanks for watching.